Division 7A is designed to prevent shareholders of private companies from accessing company profits without paying top up tax. It's the difference between the 30% paid by the company and the further tax that individual shareholders need to pay based on their marginal tax rate, which is what DIB 7A seeks to prevent from escaping the tax net. DIP 7A usually applies if the following elements are present. Number one, there is a private company. Number two, it has profits or retained earnings. Number three, a payment or a loan has been made from the company. And number four, it's been made to a shareholder of the company or the associate of the shareholder. If Div 7A applies, the payment or the loan is deemed to be a dividend from the company to the shareholder or the associate. That sounds pretty simple. But to really understand Div 7A and also to understand why it can become so complicated, we need to step into the shoes of the humble shareholder of a company. Meet Roger Dodger. He's the founder and sole shareholder of Dodger Co. Pty Limited. After founding the company and working so hard, the company has retained profits of $1 million, of which 30% goes to tax, leaving $700,000 after tax profits. Roger wants to extract this profit from his company and reward himself for all that hard work, so he plans to go buy a boat. Usually, the most straightforward way of doing this is for Dodger Co. to simply pay him a dividend, which can be fully franked, which means Roger can claim franking credits to lower his tax payable based on the tax that the company has already paid. The dividend will be accessible in Roger's hands, and he would need to pay top up tax on the dividend because his marginal tax rate, which is 45% plus 2% Medicare levy, is much higher than the corporate tax rate of 30%. Roger's already earning salary and wages in excess of 180K, so he's already on a highest marginal tax rate. This means that every extra dollar included in his taxable income will be subject to tax at 47%. In fact, he will need to pay top up tax of 170K. This is worked out as follows: dividend income of 700K plus gross up of 300K in franking credits equals to 1 million assessable income, which would then be subject to 47% marginal tax rate, which equals to 470,000 tax payable. This can be reduced by franking credit tax offsets of 300K to arrive at the net tax payable of 170K. Roger goes, "Wow, that is a lot of money. Surely there are ways to avoid this top up tax." So Roger begins to think of alternative methods of extracting those profits. So instead of a dividend, he gets Dodgeco to simply transfer him the $700,000 as a gift, for reasons of love and affection. Or Roger simply takes out a loan of $700,000 from the company. A loan is generally capital in nature, and so there's no need to include it in his taxable income. The terms of the loan are that he will repay it sometime in the future, whenever, and it's not interest bearing. Unfortunately for Roger, and for very good reasons, these scenarios are captured under Division 7A. The four elements are present. That is, there's a private company with retained profits that has made a payment or a loan to its shareholder. Div 7A automatically deems the payment or the loan to be a dividend, which is accessible in Roger's hands. Furthermore, the dividend is deemed to be unfranked, meaning Roger can't reduce his tax payable by any franking credits. So his tax payable on the deemed dividend is $329,000 instead of the $170,000 worked out for a franked dividend. If you add the corporate tax rate already paid of $300,000, this would mean that the effective tax rate on the $1 million profit is 63%. This is how Div 7A works as a prevention mechanism. It serves as a loud and clear message. If you want to access company profits, do the right thing and declare a proper, fully franked dividend.